Hey guys, so sorry that I didn't upload this earlier. Shout out to Kayla Cannon who helped me remember to upload the video in the first place. I am sitting here in my bedroom on a Friday night making this video for you guys so we won't be behind even further than we already are with Harvey and everything. So the next unit that we have is all about trade, international trade, and it's also called the foreign exchange market if you see that in review books or textbooks or anything like that. So, before we talk about the trade barriers that we have seen, let me go to this right here. Right here. Hopefully, you remember uh, the difference between not that the difference between imports and exports, and why we import versus why we export. If we're importing goods, that's because they're either not made in the United States or it's cheaper made elsewhere. Why do we export? Because people we must have the cheap thing. So people want to buy from us. Either they don't have it themselves or the US version of it is the cheapest one. Um, if you could watch the video, the Google form, and I think it's ACDC video over trade barriers, but let me just keep in mind the three types of trade barriers and what they are. The video has more about what they are and explains them better. But a tariff is going to be whoa, I can't type and talk at the same time. A tariff is the first type of trade barrier. An import quota is the second, and the third one is something called a voluntary export restraint, or a VER for short. If I can type, oh my gosh, voluntary export. I know I misspelled voluntary. You try to do this at 8:53 on a Friday night after you've worked all day. I have to fix that though because that's bothering me. Voluntary. There we go. And watch the video specifically for the impact of trade barriers for the countries that have them, and keep in mind and ask yourself, why would we have them if those are all of the effects? So we'll talk about that later in class, the effects of those and then why we have them. Um, if you have ever heard of a free trade zone, what that is a place as an agreement between countries where they're not going to have any trade barriers, no tariffs, no import quotas, and no VERs. You can buy and sell goods and import and export goods just like you were trading with a member of your own country or like a different state within countries. There's not going to be any regulations and rules. So a free trade zone that you should be familiar with is NAFTA. NAFTA is the North American Free Trade Agreement, and this was brought to you since 1994. Clinton passed this during Clinton's administration. And obviously, the three member countries are the United States, Mexico, and Canada. And there's free trade between those three countries. There's no tariffs, no import quotas, no VERs, and so good and bad about both of that. Good is that whenever you have little or less government interaction, businesses can flourish, and that's what we've seen. We've also seen better relationships between those three countries. Of course, jobs have been lost. So in some sectors of the economy, if there's cheaper labor in Mexico and there's less environmental restrictions in Mexico. So you're going to see a lot of companies that are by the border, they're going to go to Mexico or they'll even go to Canada. So in some sectors of the economy, we've lost jobs. In some sectors, they've grown. So they've kind of canceled out. NAFTA really hasn't been a hot issue since it was passed. Just recently, it's been a hot issue, but if you ever see AP test questions or ask any economist, free trade is the way to go. Trade barriers just has a net loss. There are more people that lose than actually gain. Of course, a huge free trade zone that does have some serious complications is the biggest one, the European Union. So let me type that up. The European Union, or the EU for short. There are 27 member countries of the European Union. I'm going to put an asterisk because of Brexit. Is it all capital? It's Brexit. Because it's the British exit. That's what they've called it. Britain has said that they're going to leave. They voted on leaving the European Union, but they haven't filed the paperwork. So it's like if you're like, if they're a married couple that they're split up, but they haven't filed for divorce yet. They're separated, but they're not officially divorced. So technically, they're still married. So that's like the European Union. That's Brexit. So Brexit, they have a common currency, the euro. The euro is different than what we have with NAFTA. We don't have a common currency between NAFTA, but there is a common currency between some of the countries of the European Union. Not all 27 countries have the euro. I believe, I haven't looked at this number in a while. I think it might be 11, but it's not all 27 members. So fact check me if I'm wrong on that. And the thing is, with one currency, you have one central bank. And the problem with this free trade zone is, since they have, several countries with the same currency with only one central bank, what does the central bank do? If one country, let's say Germany, has a really flourishing economy and might even have an overheated economy, they might suffer from an inflationary gap. Do you fix that? Or do you fix like a country who might be having a recession, like Greece? Ooh, if I can spell it. Greece. Keep in mind, the central bank, which we'll talk about later, deals with interest rates. So should we lower interest rates to stimulate an economy, or should we raise interest rates to slow it down? Well, if you have two different countries with two different economies, which one do you solve? Which one becomes the bigger issue? So that's the problem with having a free trade zone like the euro, like the European Union, because they have a common currency, and that's hitching your wagon onto someone else's fate. So not always works out for the best. And then we have the World Trade Organization, which is just an organization that promotes free trade. There are many, many member countries. You see all these countries in dark blue. They're member countries of the World Trade Organization, the WTO, and their just goal is to promote free trade and to stop trade wars. There have been trade wars like the Pasta War and the Beef War. All of these are real. I think the Beef War of 99 and the Pasta War of 94, I think, or 85. Someone is going to have to fact check me. I don't have my notes in front of me. I'm at home. It's Friday. I'm going to go to bed. So that is just a brief thing about the WTO and about free trade zones. But the meat and potatoes of this lecture is something called the balance of payments. So the balance of payments is the record keeping of transactions between countries. So it's like the accounting of any transaction that goes on internationally. It's like which transaction is going to be filed under which section of which account. So that's what the balance of payments are. And there's three accounts that you're going to have to really know very well for the AP test. One of them is the current account. You see there in the middle of your screen. One of them is the financial account. That's what we're going to call it nowadays. They used to call it 5 years ago the capital account, but since then the United States has switched the name that they call it, and they call it the financial account now. So if you ever see worksheets, handouts, books, reviews, whatever, that use the term capital account, that's going to be an older reference. That's an older term for it. The newer term is the financial account. And slowly that's going to trickle down to, education and textbooks. So we're still kind of in that transition. And then the last account is called the foreign exchange reserves. It's also called the official reserves account. So if you ever see foreign exchange reserves or official reserves, that's going to be the same thing. So a couple quick definition things before we move on into what is in those accounts is I wonder, okay, I'm not on my computer at home. This is my Chromebook. I need to grab this. Can I make this larger? Is that possible? I can't click and drag. Oh, wait, what's going on? Oh, can I just make the font bigger? Can that happen? Oh, that didn't happen. Oh my gosh. Why is my life like this? Okay, well, you just kind of have to put some glasses on or something. So, money coming into a country, if money is being brought into the United States, it's called a credit. Um, just like if you get credited on your account, that would be like money coming in. Like store credit is free money. If money's leaving a country, it's a debit. So if just like you run your debit card, that's money leaving your account. So money coming in, it's a credit. Money leaving is a debit. Another word to say that, another way you can say that is if money coming in is not only a credit, it's also called an inflow of capital. And money leaving would be an outflow of capital. Inflow versus outflow, credit versus debit. Here's the thing. This unit, because it's a different unit, and we're talking about like buying things from different countries and investing in different countries, the term capital in this unit right now is another way to say money. So we're not talking about pizza ovens. We're not talking about capital stock. Please don't shoot me. We're not talking about anything. We're talking about actual money, physical cash. So money coming in is an inflow of capital, meaning money, or a credit. Money leaving is an outflow of capital. Also a debit, but still capital being money. So hopefully that's not too confusing that now we're actually talking about capital being money, because this is an accounting unit. This is not an economics unit. It's more goes in the line of accounting, but it's accounting the economy, which is why we're talking about it. So anyway, let's look at that very first account, which is called the current account. One thing that's in the current account is trade. All trade, net exports, basically exports minus imports. So if we're buying something from Mexico, or if we're buying something from Canada, or if they're buying, if someone in France is buying something from us, that's going to be recorded in the current account. Notice how it says visible trade versus invisibles. Visible trade would be buying goods that you can touch. Invisibles would be services. So goods and services, visibles, invisibles. So you can buy a shirt. That would be a visible trade, but you can also, like, if you need help desk, some technological, and you get sent to a call center in like India, that would be an example of an invisible trade. You're getting a service, you're just not getting a physical service. Wait, wouldn't that be good? Anyway, moving on. The next thing is net foreign income. So any money made, profits, interest, income made on foreign investments would be in the current account. So let's say that you have a savings account in like Switzerland. You've always heard of people talking about like Swiss bank accounts. So let's say that you earn interest on that Swiss bank account. That interest would be accounted for in the current account. If you, let's say, if you were to buy like Ford stock, that's Ford. It's an American company that's going to be bought and sold on the New York Stock Exchange. But if you're buying stock of like Honda stock, well, Honda's not an American company. So you're going to be buying and selling that on the Nikkei, the Japanese stock exchange. And if you make any interest, any dividends, any profit on this stock, then that profit itself would be in the current account. And the last thing in the current account is unilateral transfers, one-way transfers of money. If you send like family relatives, if you send relatives just like $100 a month or something. They live in a different country and you send them cash from the job that you have here. You're not buying anything from your relatives. You're just sending them money. It's a one-way transfer. You're not getting anything in return. You're just sending money. That would be an example of unilateral trade. It could also be like international aid. So like if Haiti has an earthquake or a hurricane, destroy infrastructure, and the United States just sends financial aid, or they're not buying anything from them, that would be an example also of unilateral transfers. It's just a one-way transfer of money. Okay, so that is all in the current account. Trade, goods and services, net exports, basically, one-way transfers, and then any profit made on foreign financial investments. Onto the financial account. Two things, but really it's just one thing. It says medium long-term capital flows, hot money short-term flows. I have never seen that. I stole these slides. I have never seen that term ever really used. But if you ever see the term like direct foreign investment or financial assets, that would be in the financial account. Okay, what that means is the stock itself, the savings account itself, is in the financial account. Any profit made on that, that's in the current account that we just talked about, but the stock itself. So let's say you buy stock for $100 and it earns $10 and then you sell it. And so you get $10 profit. So that $100 that the stock originally was goes in the financial account. But the profit of $10 that you made on it, that goes in the current account. So it's kind of split up that way. You also see here it says business real estate. So there are, like there's Disney Worlds, other places besides like California, that's Disneyland though, and Florida. There's one in Paris, and I heard that there's one in Tokyo, maybe, I think. And they have to buy the land. That's a financial investments themselves. So the land that Disney World buys, that Disney buys in another country, that land itself is a financial investment. They're going to be developing that land and trying to make that land into a business. So the land itself, the purchase of that land, is in the financial account. Any money that they made from ticket sales or t-shirt sales or whatever, that right there, that goes in the current account. But the land itself, the investment itself, the stock, the bond, if you ever see the term bond, that's going to be in the financial account as well. Any the Swiss bank account, all of that is in the financial account. Any money made on top of that, current account, but the investment itself is financial, also called capital, but mainly financial. So these two accounts, the current account and the capital account, should always sum to zero, meaning if there's a deficit in one, there's a surplus in the other. If there's an inflow of capital in one, there's an outflow of capital in the other. Another way to say it, if there's a credit in one, there's a debit in the other. They should cancel each other out. So if one is plus 100, the other one should be minus 100 to equal to zero. They should balance itself. That's why it's called the balance of payments. But sometimes life doesn't always work out that way. And that's why we have the last account called the the financial exchange reserves, or the official reserves. And what that is just basically the net change, as in the extra stuff that they have. Let's say if I can I type easily? So let's say in the current account balance is like $100, like positive 100. There's a surplus of $100. So plus $100. In the capital account, let's say, there's going to be a deficit. There's going to be negative, but let's just say, let's just say there's negative $90. Well, that doesn't balance out. One's plus 100, one's minus 90. It should be minus 100, but it's not balancing out. So what they're going to do is they're going to take $10 off of this 100 to make it 90. They're going to take $10 off, make it 90, and then they're going to throw those $10 over here in the foreign exchange, which is basically a big vault where they just keep extra foreign cash. They put extra pesos and extra euros and extra yen and rubles and rupees and whatever they have that they're other dollars from different countries are going to be in this account just to balance the balance payments. That's the goal. That's the only thing it has. It doesn't really do anything else. So it's held by the central bank. The central bank is the Federal Reserve Bank of the United States, and its goal is to balance all the other two accounts. So if this right here would be like a surplus that they're throwing in the future, there might be a deficit. And so they cover it with the surpluses from the past. So, like, it's their rainy day fund. Like, oh, we have too much money now. So let's put it some in the official reserves. Oh, we have a deficit. Well, then let's throw it back in there from the surpluses that they had in the past that they've accumulated. Okay, so those are the three accounts: the current account, the financial account, and the official reserves account. What that looks like on a test is, hopefully you can see this. I don't know if I can click and drag in the way that I can at school. I don't think so. It's like my order. Yeah, that's just no. Okay. You see that there's just different numbers and things that have to total up to equal zero, and so basically this is just saying, oh, they have a trade deficit on goods of negative 20. They have a trade surplus of services of 6 for a total of negative 14. So this country has a trade deficit. It looks like the United States. China would have a positive number in their current account because they have such a trade surplus and we have trade deficit. Well, the financial account doesn't have it equal to zero. They have, wait, hold on. They have even more in the current account. They have negative 26 because I forgot to add the investment income and net transfers there. And then at the bottom, well, the balance on the capital account is 15. The balance on the current account is negative 26. That's not going to equal out. So they might say, like, what does the official reserves have to be for it to be a balanced balance of payments? So it's like, oh, positive 11 because negative 26 plus 15 plus 11 is zero. Now it's balanced and everything's good. So hopefully this makes sense. There's going to be a quiz on Tuesday about the types of trade barriers, the effects of trade barriers, free trade zones, and balance payments. It's going to be a doozy. It's going to be like 10 questions. I really need to make it. Note to self, make a quiz. And it's going to be a doozy. So hopefully you come prepared on Tuesday. Hopefully everyone has a long and safe weekend. It's going to be a good day on Tuesday and then senior picnic on Wednesday. It's going to be a good week. So everyone have a good weekend and I will see you whenever.